Okay, I think we're on. Hi, my name is Brad Weirick. I'm a partner at Gibson, Dunn & Crutcher. I'm co-chair of our emerging companies practice group. Our panel today is on private company liquidity, and what we mean by that is the phenomenon of founders, employees, early investors getting an opportunity for liquidity by selling shares prior to a company's IPO. As a lawyer and having done this for a long time, a very quick historical perspective is that lawyers and companies historically were not big fans of liquidity for their employees pre-IPO. There have been restrictions on transfers, and companies historically have just frowned upon it. And yet, maybe beginning with sort of the Facebook second market phenomenon and secondary sales in advance of the Facebook IPO, it has really grown. This past year, some people estimate that maybe as much as 20 billion or more of secondary sale transactions have occurred, and it's growing, doubling each year potentially. So we have a panel today made up of representatives of various players that have an interest in this and have interesting perspectives on this phenomenon. We have a representative of a venture-backed company that's only been around for a couple of years, right, that has already had a company involved in endorsing secondary sale transactions by early investors or employees. We have a representative of Carta, which is, as everybody knows, sort of the party of record with respect to maintenance of the cap table, but also is providing a sort of a platform for these types of transactions. And we have a representative of a private equity fund that is engaging in sponsoring and purchasing shares on in secondary transactions. So I'll let the panelists sort of quickly introduce themselves so you can tell everybody who you are.
Mm-hmm. Sure, so I'm Larissa. I was employee number 1 of Brex, which is the first corporate credit card for startups. We're based in San Francisco and started in January of 2017 at the Y Combinator class of winter 17. And in 2 years, we've been growing a lot. We're over 120 people now and have been through 3 rounds of investments. Our most recent one was in October, a Series C of a valuation of $1.1 billion.
Great, and my name is Andrea Lamari. I head the liquidity solutions team at Carta. So Carta is formerly known as eShares. As Brad mentioned, many of you might know eShares as the cap table stock plan company where you get issued certificates either as investors or employees. My team is a team that was formed last year as a way to build products around solving private company liquidity. Carta itself just closed our Series D round at an $800 million valuation. We just hit 500 employees, 6 offices. And then prior to Carta, I led the West Coast team at NASDAQ Private Market for a few years. And prior to that, I started and co-founded a company called Equidate, which recently rebranded as Forge.
I'm Rob Ackerman. I'm the co-founder and director of Founders Equity Partner. We are a direct venture secondary firm focused on cybersecurity and the data sciences, $100 million fund. Prior to Founders Equity, did private investments on the secondary side in Lyft, Alibaba, Twitter, Palantir, et cetera. We've been around for 4 years, and we primarily are focusing on partnering with companies to build structured liquidity programs. We'll get a little bit more into that later in terms of how that works.
So I mentioned increasingly companies are becoming more accepting of these kinds of secondary transactions, and I guess I wanted to start with Larissa, sort of explaining the company and the early employee equity holders' perspective on this.
Sure, so just a slight correction, we haven't necessarily conducted secondaries yet, but we have started the conversation with the employees that this is something that we fully support. We want them to be able to, get wealthier as they go and not be constantly worrying about one date, one potential IPO in the future, so that they're not taking just conservative decisions. They can be aggressive. They need to be protective of that particular valuation right now, and that we are de-risking them a little and allowing them to just think on the long-term mission and rest assured that we are, we will be able to offer this liquidity throughout. And that's really important because you don't want the internal pressure of what we call an IPO clock. We want it to come at a time when it's best for the company, and we don't want the decision to be influenced at all by internal pressure from the employees who want this liquidity. So we're for it. We've started the conversation that this is going to happen, and we're going from there.
Is that a conversation in part between management and the board, and management pushing for it for the reasons that you said, or?
Not at all. It's actually something that comes from the founders, Enrique and Pedro, and it was communicated during our all-hands meeting. We are a company where everybody owns stock, and in an event like that, options at least. In an event like that, everybody, we wouldn't discriminate based on seniority. There would probably be some cuts on tenure. We would probably require that you have vested for 2 years instead of just 1 year, but this is something that we're very clear about, just like we are about anything regarding compensation, regarding early exercising. It's really, in the end, a matter of making sure that everyone's making the best decisions for themselves. We definitely don't want to be in a situation, for example, where gold handcuffs, right? We want people to be there because they believe in the long-term mission. They want to be there, not because they have to, or there's other forces keeping them there.
So I want to talk very briefly about the types of transactions we're talking about when we're mentioning secondary transactions. There's obviously one-off transactions where founders are finding buyers, sometimes through platforms, sometimes in one-off transactions. And that is still the vast majority of what we're talking about with secondary transactions, founders, early investors selling. And one issue that has created, and one of the reasons why companies have a little bit of angst about it is, they lose track of who's on the cap table, who their shareholders are, worries about the proliferation of their shareholder base, which, as oftentimes company counsel, I worry about when you get to an exit and, how many people do we got to round up to vote for this deal. There are private tenders. There are auction transactions that are going on in secondary transactions. There are certain players that are coming to these transactions that are doing sort of more hybridized transactions where they're loaning money to the founders. They're doing forward sales or forward loans. Those are transactions that are sometimes being done because the investors in those transactions maybe don't want to surface the transaction and seek consent from the company. They might have an approval right or need to give a waiver. Those transactions also arguably maybe allow the seller to defer the capital gain event. But Andrea, why don't you tell us a little bit about private tenders and auctions and those types of transactions?
Right. I'm happy to. So if we want to address just kind of the general framework, right? So the way that these transactions are occurring, and of course, just to really specify here, we are talking about private company secondary direct. So these are shares that have been issued. They might be in the form of stock options. And in the case of stock options, what would occur in a transaction in most cases is that the concept of a cashless or net exercise would occur for these stock options that have been issued to employees. I'm happy to discuss with anyone after the panel the kind of nuances of how the cashless exercise works, but more or less, the employees who might have a really high strike price on their option grants would, in a sense, be able to sell them all in the same single day, so it's considered a net exercise. They don't have to put the cash up front. So the way that employees are able to do this is that the company says, well, we're going to offer you the ability to sell, or we're going to offer you a streamlined process to sell when you want in the form of a one-off transaction. So a one-off is where you're selling one buyer to one seller to one buyer. It's not a scaled transaction. So some of you might be familiar or know about tender offers in the public markets. Private markets have a bit of a different set of rules. In a private tender offer, this is usually something that is reserved, or at least has historically been reserved, for later stage companies, but now we're actually at Carta seeing them happening on the Carta platform as early as the Series B. But private tender offers are where there's 10 or more sellers, and the company or the buyers are setting the price and they're setting the rules. So there's a bit more constraint around it, and there's a period of time of 20 business days during which one of these tender offers has to be open. So those are happening, they're active. For Carta, they're very turnkey because, of course, Carta has the cap table, so we could do it all in a seamless transaction. But I think where, especially when we look at Rob's experience, the world of one-off transactions is far more frequent and there's a lot more volume. So this is the next space that Carta is exploring building around because we see a lot of opportunity in accommodating issuer-sanctioned one-off transactions at scale that don't have to be in a programmatic tender offer format. So, Rob, I'd love to hear your thoughts on it.
I agree. You guys do a great job. No, I totally agree. I mean, when we look at it from the founder's equity perspective, we very much approach secondaries more as a service to help our own portfolio companies. The team has secondary experience going back to 2002, where liquidity wasn't a common or talked about thing. Obviously, you flash forward to today, average time to exit's about 11 years. Cost of living, especially in the Bay Area here, is increasing. What we said was, we have to be kind of cognizant of that and find ways to support our founders and employees to make sure that the long-term alignment of interest was in place. So if you look at that sort of triangle, you've got the founders, you've got the board, and you've got the employees. How do you make sure that they're able to focus on that long-term vision? Starting a company is sort of like pulling a 1,000-pound boulder uphill. Kind of goes against the laws of gravity. And the key to that is having the right team in place. So what could we do to help them? And that's how we always approach it. We approach it as a partnership. I think when you look at the secondary market right now, especially in the current cycle, it's a pretty hype cycle. There's lots of valuations out there. There's a lot of real transaction-based buyers who are not about alignment of interest. They're either about collecting fees or just writing checks and putting pretty logos on their deck and raising more money from investors. We wanted to approach it from, we want to add value. We want to be long-term. We want to be strategic. We want to make sure that nobody's selling out because ultimately we're staying on the cap table to exit. So it's in our best interest to make sure that the right people are at the table at all times. This is just simply a tool to help facilitate that.
And what you're getting at, Rob, in part is sort of your pitch to a company that's considering, participating or at least endorsing a program where you're the buyer, and I'm sure it's easy for you to describe, but what you would bring to the table for a company is, I think, a lot of comfort with respect to your level of sophistication around these issues.
Sure. I think a lot of times secondaries come up for one or two reasons. You've got an individual founder who has probably both like one of the largest equity slugs and probably the ability and motivation to be able to sell his shares. That happens is usually pretty easy as long as he's selling a small enough percentage. The board is usually supportive. But what we're seeing more and more of, and I think this sort of goes to what the rest of the team was talking about, is more and more companies are being proactive. We're seeing secondaries taking place earlier. It tends to be a function of the valuations that are being raised at the A's and B's. People are seeing very large numbers on their individual balance sheets, and they like to capitalize on that. But the companies are beginning to realize this is a thing that's not going to go away. We need to address it now. We don't want a situation like Facebook or any other ones where shares are trading in the wild and all of a sudden you have a soft IPO and people are coming out of the woodwork saying, hey, we own 20% of your company. Nobody wants that. So companies are being more proactive. So I think if you look at the total number of company-sponsored transactions, they're doubling on a regular basis. And we have a lot more inbound interest on our end asking, hey, can you help us set this up? What are the issues? How do we do it right? Because at the end of the day, they want a trusted counterparty. And there's a lot of ins and outs. And I don't want to glaze over everyone's eyes with the technical details of 409As and QSBS, but I'm happy to talk about it afterwards. What you need is a partner. 11 years is a long time. There's an opportunity and there's a need now in the life cycle of a venture company to bring somebody in that's going to kind of help fill that and be that trusted counterparty. The one thing I will caveat is that what you're seeing a lot more of is the traditionally primary investors are now participating in secondaries. When you see the mega rounds that are taking place, 100 million plus, a large part of those also tend to be secondary transactions. It's a way for those primary investors to deploy the massive amount of capital that they have and increase their ownership share. And it allows some relief to the early investors and early employees. The one thing I will caveat about that is that when the market turns, and it always turns at some point, that pool of capital will probably deteriorate. That capital that was going to secondaries from the primary guys will get earmarked for follow-on rounds and protecting their positions through the next cycle. What you need is a partner at the table, this is the plug, partner at the table who's going to be there throughout the entire thing. And that's all we do. That's the entire point. It's to help companies get through, achieve that long-term mission, build companies, and get to a meaningful exit.
So a question that I think people in the audience might have, and maybe this is for you, Andrea, like what talk a little bit about what actually happens, with a program when you're setting up a program for, say, a company tender or a third-party tender that the company is supporting, or an auction. Give it a little bit of sort of concrete description of how it goes down, how it gets set up.
How it plays out?
Yep.
Yeah. So when a company comes to Carta, right, 99% of the time they're already a Carta customer, so we're working with them in the capacity of managing their cap table, issuing their equity. So usually we'll be working with a CFO, general counsel, or the outside counsel of a private company. And they generally have expressed interest in offering liquidity. It's for recruitment, it's for retaining the best talent, competitive reasons, and they'll say, okay, well, what's next? We're all for all of those things, but what do we do about setting this up, right? So I would say the first thing I do tell companies is, what is this kind of transaction going to look like? Is it off the balance sheet, right? Or is it going to be in the form of a third-party investor, much like Founders Equity Partners, coming in to buy the shares? As Rob mentioned very briefly, but if anyone here is familiar with 409A, fair market value, these transactions that are happening, right, they're happening in illiquid stock. They will impact a company's valuation depending on how your valuation firm does weight the transactions. And obviously the plug for Carta is that Carta is also now the largest 409A provider in the country. So our team does work with you if you want to get a sense of whether a transaction will impact your valuation. So I'll say, okay, who's going to buy the shares, right? And so, as we talked about with Brad, a lot of these companies that are running transactions will raise a round of funding, and then they will work with the board to determine whether a slice of that funding round will be used to repurchase shares and retire them, or they'll have an investor who's either on the board or who came into the round, or maybe even a completely separate investor with no economic interest in the company come in and buy the shares. So I will say this. Carta ran the stats for the large volume of transactions we ran in 2018, and we actually saw that when investors buy the shares, this is going to be like but when investors buy the shares, there's usually a 52% premium in the offer price relative to a buyback. So what that means is like the company's buying the shares back, they're buying them at a more conservative price, where when you bring in investors to buy the shares, it's much more competitive. And the companies have a little bit more leverage to say, well, we want a better price. And so, obviously being in the market, I've now been in this market for about 7 years. You saw in 2015, 2016, there was a lot more of a discount. And when you were selling common stock, it was priced at likely right above the 409A, if not at the 409A, right? And now it's very interesting because my team we run about 12 to 15 structured programs a month, whether that's in the form of an auction, Dutch auction, tender offer. Carta can do all the above. Or we also have around 13,000 one-off transactions being reflected in Carta every month. So it's a very high volume, and that's why we're building new products to accommodate the one-off transactions. But anyway, so we'll see this. We'll tell the companies, listen, figure out who's going to buy the shares, and then figure out whether you want to set any criteria around it, right? So as Larissa said, something that companies commonly do is they'll say, well, we want to reward the folks who've been with us for a minimum number of years, or we want to separate out the tranches and say that founders are going to sell this much, employees are going to sell this much, and former employees are going to set another. So a way for Carta to, eat its own dog food. We have now run 2 tender offers on the back of our Series C and our Series D. Both were, what we would consider to be successful. And overall, Carta, obviously in the form of a buyback, allows you to have far more control over the whole thing versus having to negotiate with a third-party investor to figure that out. But I will also say, as like a final remark on all of this, is that we are seeing unprecedented low sell-side demand. So sellers are not selling. They are holding on to their shares. The insiders, as Rob, are also buying the shares very heavily right now. So the board is just increasing their pro rata, or just they want to add to their position by way of common shares. So overall, there's a lot of I would say bullish activity happening in these transactions. So before you go off and spend a ton of money on launching a tender offer, please talk to us, whether or not you're a customer. Please talk to your lawyers. The biggest thing I see companies do is spend upwards of $500,000 in setting up a private tender offer transaction, and then no one sells. So they spend all this money on legal fees. There's really 2 legal documents you need, and Carta gives you the templates, and they put in all this work, and then no one wants to sell. So we have ways that we can help you poll your shareholder base in a very comfortable, anonymized way, so you can get a sense of the sell-side demand before you go out and do something.
Real quick, because we run out of time so quickly on these panels, I wanted to just have a sort of run down some of the issues that companies and founders and people wanting to sell have to think about in doing secondary transactions. And I would give it a caveat that if you're going to embark on this, consult with your accountants and your lawyers, and because there's a lot of issues. First and foremost, the obvious one is that if you are an early shareholder, founder type in a company, there is typically some sort of company consent hurdle that you're going to have to get past. There may be a transfer restriction, a hard restriction, or a securities law restriction. There's a right of first refusal in co-sale very often, and so a waiver may be needed. One of the more interesting issues from my perspective as a lawyer is around the disclosure issues and confidentiality with respect to that disclosure. And I would frame it this way, that if you are a company and you've got an early investor or a founder wanting to sell shares, and the company is not realizing any proceeds from that transaction, and I've taken this perspective as company counsel, why do I want to put the company at risk and put out company information to help the parties to that transaction? Now, what we're learning about and hearing about is there's an evolution here where companies are more endorsing secondary transactions. So that is changing to a degree, but nonetheless, the issue and the risk around the information that's shared and who bears the risk, and is the company putting itself at risk in providing that information for these other parties transacting is very interesting. And Rob, I think you'd have some interesting perspectives being an investor in those transactions and the information you insist upon.
Yeah, I mean, we approach it again from a pretty traditional venture background. So, in terms of our diligence process, it looks like any other venture diligence. Now, that can catch some people off guard. It all depends on what kind of buy-in you have from the company. I would probably caution, if a buyer comes to you and wants to buy your equity and doesn't want any information, it's probably a bad sign. Here's what I would say at a high level. Right now, you have lots of choices out there. There's a lot of equity. There's a lot of dumb money, and there's a lot of people just looking to write checks. So you have your choices. Take a moment, pause, try to think strategically, try to think long term, and focus on your employees. I'm a former military guy. I really believe in the team. That's why we started this, to help teams focus and to work together. Take a moment to make sure you find the right partner, whether that's any of us up here or whoever is the right fit for you. Take your time, do your diligence, make sure they're asking the right questions, because what you want is someone that's going to be your partner for the long term. And that's very much a relationship. So take the time, date accordingly, and try to pick the right partner. So.
Rob, what you're hitting at also is that what a lot of private companies don't realize is that insider trading rules apply to them. And so Rob's hinting at the disparate information that may exist in a transaction where, Rob will come in and do due diligence and be educated, but sometimes he might be dealing with a seller who has less information than him. Sometimes there's a seller who's the CEO who, by definition, has all the inside information, and there may be a buyer who comes in and does no diligence. Some parties may say, well, whatever, don't worry about it, but you should understand that insider trading rules apply to that, And the SEC is potentially going to find a test case to really sort of deliver a message on this. So people should be thoughtful about that. I think a lot of transactions go down with people not thinking about that as much as they probably should.
Yeah, I would say this is, and I know we're running very short on time here, so if you're a company or you're a seller, you're a buyer, you're interested in transacting, right, just be ready for disclosure. I would say my general advice for companies is be ready to provide a data room. I'm going to be looking for 2 years of audited or unaudited financials. I'm going to look for forecasts. I'm going to look for a summary cap table, a management deck, risk disclosures. Just have these prepared. If you're a company that qualifies for Rule 701, and just so you're aware, you'll know when you qualify because your lawyers will tell you every day until you disclose. You should just be ready to share information. Obviously, from Carta's position as like the platform provider, we have to stay arm's length. We are simply executing the transactions and giving you best practices. But what you don't want to have happen is your former employees, come back to you 2 years from now with some sort of litigation and say they were uneducated or ill-informed. And I mean, it's going to be unfortunate. And I absolutely see that the SEC is going to look to make an example out of someone. So I think it's kind of a ticking time bomb. And overall, Mary Jo White, when she was commissioner of the SEC, had come to the Valley at one point a couple years ago and said, information symmetry is what we're looking for in these types of private resales of securities.
That doesn't mean don't do secondaries. Please do secondaries.
Oh, no, absolutely do secondaries.
Just do them right,
Yes.
and ask lots of questions.
And be transparent, right, Larissa? Like, that's what you had been saying.
Absolutely, and from our perspective, as well, just really quickly, in the end, for a company, it's a matter of creating the best compensation program to have the very best people at all times, and doing it in a way that you are, especially like valuing, not punishing earlier employees. Aside from the liquidity that we want to start providing, one of the things that we do that I haven't seen anywhere else is when we do promotions, we let the employee choose between a bundle of more options to be vested over the next course of 4 years and cash. And these things like setting up secondaries and etc. used to be like really hard because there's a lot of things that we need to do. It's distracting. And so things like Carta actually, and we really appreciate you guys, help us structure that in a way that is transparent and we can do quickly, and it's for the benefit of everyone.
Well, we are unfortunately out of time. This topic you could talk for hours on probably. There's a lot of other issues. We didn't get into some of the minutia on 409A and comp issues and the like. People from the panel will be hanging around if folks in the audience want to chat about those issues in more detail. I think that this has been a good discussion, and it's just, I think, a snapshot on what's going on in the evolution in secondary markets and platforms and investors. So hopefully it was helpful. So thank you.